All right, hello and welcome to an afternoon session of Trading in the New Economy. Usually we do this in the evening, but I have a prior commitment and wanted to make sure that I was accountable and still got this webinar in today. We've had the holidays and things like that, so it gets a little funny with scheduling as you roll into late November and into December. So I was just actually creating my webinar for December. I usually do 2 a month. I'll be doing one. It'll actually be a year-end review and a look ahead, so look out for that one. My name is Brian. I have a boutique consulting company called Jupiter Peak Financial, where I educate individuals, small businesses, organizations, investment managers, organizations and institutions such as universities. I actually teach down at the University of Utah, and I help people basically to trade, invest, create income off of their equity holdings, and also really important is protect their equity investments in sideways and down markets. So that's what Jupiter Peak Financial does, and obviously I also work with brokerages as well, such as Interbank FX. My daily blog, I haven't updated it in a couple days, just been really busy, but that is the daily blog there that you see, or market commentary that I do at financebanter.com. I also go ahead and duplicate that on the daily Forex Trading Edge.com for on the Interbank FX website there. And then as you'll see at the end of the slides, I also try and update you intraday as far as what I'm seeing, and I do that through the Interbank FX Connect site there called, and my tag name is The Locals Take. I haven't participated too much this week, just like I said, it's been so busy, but really it hasn't been that busy as far as the markets go, because as you can see, we're doing a lot of gapping. We opened up big on Monday, and then we went sideways. Tuesday was a kind of a sideways trading day, and then Wednesday obviously open up huge and go sideways. So a lot of the events are happening actually when we're sleeping, as far as if you're in America trading the American Forex hours basically. So getting into things, we always have to do this. Let's go into the disclaimer and I'll let you guys read that. This disclaimer is so important, you guys, in these markets. As you know, we are trading leveraged products, options, foreign currencies, the cash markets, the futures markets, commodities, and things like that. So, you know, these big moves in the stock market, a 4% move in the stock market, you know what that means for an option trader or a Forex trader. So really a theme lately has been account and trade management, and making sure that you know that in these volatile markets, you don't have to trade as big to make as much money when we are trading when the VIX is at 15 or the VIX is at 18 or the VIX is at 20, and now the VIX is, you know, in the high 20s, 30s, 40s, and all the international news going on, these huge gaps, these big moves. You know how far your foreign currency pairs are moving on a daily basis with this news, so you don't need to trade big to have a big winner or a big loser, hence that disclaimer, hence why I'm so big on trading plans, and hence why I'm so big on making sure you're trading according to your account size. The outline, quick fundamental catch up. I mean, it's hard to catch up with what's going on every day, but we'll go into that. Then we'll go into technical analysis and combine that with the Fibonacci retracements and the definition of Fibonacci retracements and a bunch of examples. So fundamental analysis, overall, underlying that people aren't really paying attention to, the United States economy is getting better and better and better. Retail sales are good. Jobless claims are going down. The ADP report that came out today. Where do you find out all this information? ForexFactory.com. You can get there right from the Interbank FX website. And it's a great site as far as knowing what's in the background that we're not paying attention to. We might pay attention to it down the road, but obviously international events are trumping that. But overall, things are getting better in the United States economy. Time that calendar with CNBC, especially Friday morning when we get the unemployment report. You don't have to sit on Forex Factory and hit refresh. You can just listen to CNBC and they'll report it. If you're not there when it comes out, then you can go to Forex Factory later in the day and find out what the number came out as. Bloomberg TV and Bloomberg.com, great sites and places to get a good information about the world political, social, and economic landscape. Obviously, your broker provides a great amount of information. That's why I'm speaking to you today. And then obviously your other market sites. All right, technical analysis. What are traders doing with the news? Well, we know this week they're buying the stock market, that's for sure, and they've been selling the U.S. dollar. We know that relationship's in play, so we're going to look at those relationships. let's first talk about Fibonacci's. I actually taught a class at the University of Utah last night on Fibonacci's for 2 hours, and this slide came up. And we as traders understand that we don't need to know all of the data about a Fibonacci or what makes up a moving average or what makes up a stochastic. We need to know how to read it and how it works and how we relate it to our trading and investing scenarios. So people kind of laugh at me when they ask me questions. I give them a direct answer. I say, you go find out that information, have fun. I'm going to go and trade the markets and make money. So obviously it's always good to understand what the indicator means, how to use it. But once you get past that very, very quickly, then you actually want to just go and use it live, live or virtually in the markets and start to play around with it. But Fibonacci retracements are very cool. They came up, if any of you read the Da Vinci Code, in not the movie, but actually read the book, they go in extensively into Fibonacci numbers. They're in our bodies, they're in seashells, they're in sunflowers, as you can see. But very, very interesting how they show up in life and how it's so funny as a trader and knowing how to use them trading, and then you hear about them coming up in other books and movies and things like that in other places in our life. So Fibonacci is very, very cool. I guess I'll have to go to Italy sometime since I use Fibonacci so much. I guess someday I'll have to go over and find Leonardo Pisano Bogolo's home, I guess, and go pay him a visit, and maybe I'll have to leave a few lira, but obviously euros. Who knows? We might be back at lira someday. I'll have to leave some euros at his doorstep. So why are Fibonacci's used? They create a trading plan. They help you with risk reward. They take current information into account, and the most important thing I can say is they tell me where I am now versus where we just were. So they give me a spatial relationship, where I am now versus where I just was. Not a holy grail. Nothing is guaranteed, as we know. We just had the disclaimer up there. All indicators really do work. Stochastics work, moving averages work, Fibonacci retracements work, Fibonacci extensions work, MACDs work, whatever you want, trend lines work, chart patterns work, whatever you want to go to, they do work, but you have to obviously combine them with fundamental news that's going on, with other technical indicators that you use, and then basically you have to decide with what's driving the markets if you're going to actually use that indicator there and how to use it with the trend and things like that. So everything works. It's just a matter of staying with it. You can't just use an indicator, have a loser, and then say that doesn't work and go on to the next one. Every indicator works, but you have to combine it with other information. I'll be checking for questions here and there, so if any questions come up, please type them into that questions function there. We have a pretty large crowd today. For some reason, I guess my crowd likes me to talk because not many questions show up when I'm teaching live in a 2-hour class like I was last night. Questions left and right, and I always answer them, and they lead to other topics, and it's great. So please ask away. If it's something that is totally off the subject, I might say follow up with me, or if it's something that's individual to you, same thing, follow up with me. But please take advantage of this time to ask questions. So using Fibonacci's, we read charts from right to left, but we draw Fibonacci's into the future from left to right. We can't draw them backwards. We have to draw them going into the future. So read the charts from right to left, but draw from left to right. You have to measure the move. So if you're drawing a Fibonacci on an uptrend, you have to draw it in the direction of the uptrend. So you start your Fibonacci at the bottom of the uptrend and end it at the top of the uptrend. If it's a downtrend, you start at the top of the downtrend and end it at the bottom of the downtrend. And remember, the key word is retrace. How much has the trend been retraced? So Fibonacci levels, the main ones that are out there, and I use a lot of them, the main ones that are out there, and you can write this down, are the 38, the 50, and the 62. I mean, I'm just giving you the rounded numbers, but 38, 50, and 62. There also is the 23 level, and then the 76 level, which I also do use and have and understand what they mean, but the main ones that are used are 38, 50, and 62. Okay? All right, so just checking for questions there. All right, let's move on to the next one. So that's kind of getting to the end of the slide. So let's go into the markets. Unfortunately, with this Yahoo Finance that I use, because it all works and depends on what brokers have relationships where, since we're using Interbank FX as a Forex-only broker, I have to go to a generic site for equity charts. But I'm looking at a 5-year chart here. This is the top in 2007, and then we started to fall off in late 2007, all of 2008, and early 2009. And as we know, the markets have recovered and retraced in 2009, 2010, early 2011. I can't draw it, but I can tell you that if you drew a Fibonacci from the top here and drew it down to the bottom here, it would retrace 23%, 38%, 50%, 62%, and right here is a 78% retracement. So at our highest earlier this year, April of 2011, we retraced 80% of the down move from 2007, 8, and 9. Unemployment hasn't changed. Countries are falling apart, basically, and we've retraced 80% of the way. I don't think we do that without government intervention and stuff like that, the stuff we're seeing this week on a much smaller scale. So keep that in mind, that the stock market has done very, 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 very well over the past 2 years. Nobody knows where we're going in the future, or else we'd all obviously wouldn't be probably sitting here. But the point is, nobody who you talk to has ever been through this kind of government intervention and easing and coordinations that happened today ever before. Maybe it happened in the 1930s with the Great Depression, but I think you'll be hard-pressed to find someone to talk to who traded through the Great Depression. So this is new stuff for every single person out there, and all we can do is trade according to who we are, what resources we have, account size, risk tolerance, time available to trade, and we have to make the best decisions possible given the fundamental and technical news out there. Moving to the smaller scale, okay? So this is the long term. Moving to the smaller scale, and this is where I'm going to start to relate into the relationships between the equity markets and the foreign currency markets. October was the biggest move I've seen in that short period of time. We went from down here to low all the way up to about 130. So it was about 105 or so to 130, something like that. So if you start your retracement, you would draw the starting of the retracement here and draw it all the way up to the top. Whoops. Let's get that back there. All the way up to the top. And that October move was 16%. And then as you see in November, as we started to fall off, just eyeballing it right here, you can see it's basically almost the middle point of this whole move. So we actually fell to 61%. This low right here on Friday, the day after Thanksgiving, was the 61.8 to 62% retracement. Now I'm going to flip over and I'm going to show you the pound. The same exact time frame, the October up move in the stock market and then the November down move in the stock market. Let's look at the pound over the exact same time frame. And actually it's already up here because I was doing this last night for the class. October up move, and then the impending down move. So what happened to the pound as the stock market moved up 16% in like 18 days, the biggest move I've ever seen in 16 years of trading and in consulting. So the pound went from 1.53 over there on the right axis all the way to 1.61, so about 8-9 pennies. Okay, and as the stock market rolled over, and some of these big red bars are Italy and Greece, you know, when that was happening, the stock market starts going down, and like I said, retraced 61.8% of its move of October, and you see the pound retraced a little bit more, about 76, but that makes sense because the pound is close to those European countries and things like that. If you even want to look at a better chart, and actually I'm going to take the Fibonacci off it, and you guys can tell me without even looking at the Fibonacci, okay, how much did the euro retrace of its October up move? Here's October, stock market up, euro up, and then Greece and Italy and uncertainty, and the stock market goes down to the 61.8 mark. The euro retraced basically 90%, 95%, almost 100% of its up move, okay? What we want to take into account here, the more that a stock or currency pair or any entity out there retraces, the harder time it will have getting back up to its old high. So uptrend, 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 uptrend. We start to retrace 23%, 38%, 50%, 62%, 78%. The stock market is going berserk right now. All this uncertainty in Europe, isn't making the pound fly to the moon. The pound is going up, but it's not up at its old highs, where the stock market is basically all the way back up here. So let me flip very quickly to the short term of the stock market. I'm just going to go to 1 month chart, and it won't show it today because this hasn't updated. But today we got to 125 in the S&P. I think we were up like 45 or 50 points or something like that. Biggest day I've ever seen, I think, besides, post 9/11 and that kind of stuff. So today we got to 125. So here we are back near our October, early November, October high, in late October highs. We'll go out to a 3-month to show you. So 125 is where we're at today, and the highest we got to in October was about 128, 129 in that area. So we're right there. But as you can see from from what's going on in Europe, the euro isn't getting the same ride. The pound isn't even getting the same ride, obviously. So we're not sure what to make of it, but this is the fun stuff. Which one is right? Is it the dollar that's holding strong here, or is it the stock market that's way, way ahead, and eventually the euro will catch up and the pound will catch up? We don't know this kind of stuff, but we can start to play it in. So me, as an investor, understanding this relationship, that the stock market starts to get weak, the dollar starts to get strong, what am I looking to do? If I'm an investor out there and I'm hedged, I'm looking now for the pound or the euro to start walking back up like it is. So here's a down move. So I start at the top of the down move and draw my Fibonacci down to the bottom of the down move. And now we've retraced 23%. And then today we retraced 38%. And we actually got to 50. So if I think the stock market has gone too far and we're going to start to give back some of those gains, I can put on a hedge and I can buy the dollar up here and short the pound. And if I'm right, I can say I'm going to get into 50%. And again, I'm just using this as an example. I'm going to get into 50% mark. I put my stop above it. A lot of people will put their stop at the next Fibonacci level. Okay? And you have to remember now, this is not a short-term trade. This is a longer-term trade. Because if I get in at 50% at 57.80 and I put my stop up here at 59, that's a lot of pips. Most intraday traders are trading for 10 or 20 pips. This would be risking 100, 150, 200 pips to make 300 or 400 pips because, again, it's a bigger hedge saying stock market's gone too far, it's going to retrace. That'll drag the euro or the pound down against the dollar. So you're looking for this retracement to see, have we gone too far in the equity market? Has the pound gone too far? And where would I like to short it? And using the Fibonacci's as a trading plan. If I get into 50 level, I can put my stop above 61.8. If I get in at 61.8, I might put my stop above 76 and then try and make my risk reward as it moves back down. Okay? Does that make sense there? That I'm using the Fibonacci to say fundamentally I'm bearish the pound. As it gets too rich, I think the stock market will start to roll over. I'm going to get into a long US dollar against the pound trade up at this elevated level. Think about it. That's a big move in a few days, right? It goes from 1.54 roughly down here all the way up to 1.58 or 59. So all I'm saying is for the next little bit, I hope that the US dollar comes back into favor and gets stronger back up at this, cheap level for the US dollar or too rich of a level for the pound for the pound. All right, let's see. I'm going to check back for questions, and I bet there's a few here because I just went crazy. What is a good book to read and understand Fibonacci's? There are so many out there. Just go to Amazon, I would say, and that's what's funny. I talked about this last night. Chartists, and traders, we have more books of psychology and discipline and stuff like that than we do of technical analysis, because you can only explain technical analysis a number of ways, whether it's Fibonacci's, Elliott waves. The ultimate book out there is probably John Murphy's book of like technical analysis of the financial market, something like that. But his last name is Murphy, and he has a good one on all different indicators. And then there's Pring that has another one, Martin Pring. But as far as just Fibonacci's in general, I don't have one. Like I said, I don't choose to read that much into it. But I would just go to Amazon, and you could probably find one out there. Let's see, and how to use it on charts. So the question is, what book is a good one on Fibonacci's? I don't think I have a specific book on Fibonacci's, even though I use them so much, because once you get the gist of it, then you're obviously combining with other information as well. But like I said, go to Amazon and go from there. If you have more questions, if you can't find one, let me know, but you should be able to find them. I don't have a specific name of one, so I'm sorry for that. Let me check another question here. That also lines up with old support around 590 on the 1st and the 4th. 59 even. So you're talking about the pound, I think you're saying that it lines up with support. I think I know where you're going with this. Okay, so if I'm going to get short up here, someone is telling me, and I think it's Nelson, who's an old buddy, if that was you, old resistance is new support. So if I draw a trend line across all of this support, then you have finally here, at this point right here, it finally used it for the first time as resistance. And if you come back up here and not only are you using 61.8 as your Fibonacci level if you chose to get in there, but you're using this congestion line of old support and resistance. Whoever wrote that, fantastic job. I love lining up more than 2 moons. So here's one moon is, I think the pound is overdone at 61.8, and my second moon is I am going to use it at an old support new resistance level, and my third moon is I think equities have overshot, and this is more of a hedge than a trade anyways. I'd like to make money on it, but if I lose money on it, it's probably because equities kept going up, 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 and my portfolio is now worth more on paper, my IRAs, my 401ks, all that kind of stuff, right? So that's the investor mentality, is when you're trading the dollar to the strength, when you're buying the dollar up here, it's almost like you're hedging it if and you don't mind losing if you have lots of big investments. If you're just a trader, then obviously you don't want to lose because your only income is from trading. But a lot of people out here have investments and things like that. Perfect whoever said that, because if you go back to the S&P on the same exact time frame, same thing. Look at the support right here. Okay, so if the S&P is going back up, it actually just blew through that level because the old support new resistance line was probably closer to like 113, 114, and obviously today we blasted right through it. So I'd like to see what happens tomorrow if we don't sell off, obviously. Anybody who's short and stuff like that, and me who uses options to protect my equity positions, and options, as we know, expire the third Friday of the month, so that's not for another 2 weeks, 12 days. I'm not really excited if we continue to go up because my protection obviously is going to lose some money, but that's the hard part. Where do you protect? When do you protect? How much do you protect? We're protecting very, very lightly because these markets are so hard to read that we're not investing, and I don't have conviction to say I'm going to jump in hard and heavy right here. But yeah, today's move definitely took it way past that same exact old support new resistance line that we're seeing in the pound that may or may not hold, who knows, but it definitely obviously didn't hold today right here in the S&P. So very, very good comment there. That's fantastic, because I did one hit on that, because that's what got me short. That's what got me to put my protection on, and that's what got me to stay in the long U.S. dollar trade for so long to protect my accounts. I was long the U.S. dollar against the pound from 1.61 down to about 1.58 or so as a hedge against equities, and because I could see, maybe is this a left shoulder, maybe is that a head, and maybe is this a right shoulder, and then it broke that neckline there and started to head down. So right now everything is different, and that's the whole point of this markets. Trade very small, trade very carefully, because things can happen in a big, large amount, especially in volatile markets. Let's see. Retracements in the big downtrend also came back and hit fibs on the way down. Retracements on the, yeah, absolutely. So we're going to start to look at some others, but absolutely. Dynamic Trading is a great book. So someone commented in and said Dynamic Trading as far as a book on Fibonacci's. So thank you for that, Robert. Retracements in the big downtrend also came back and hit fibs on the way down. I think I'm confused as far as which way you're referring to. But yeah, I mean there's bigger picture and there's smaller picture. So we've been focusing kind of on the bigger picture. Let's go to the smaller picture in foreign currencies for you shorter term traders, and let's look at more of like an intraday chart. So Monday's trade was interesting. I was looking to buy the pound because what happened on Monday? The stock market flies up big on Monday. And then late in the day, the stock market started going up 330, up 300, up 270, up 260, up 250. What did the pound do? As the stock market started rolling down, the pound started rolling down. So my thinking is, if you go out on Black Friday and you can get an iPad from Apple for $200, who's going to raise your hands wherever you are? Raise your hand if you can get an Apple iPod, retails at $400, and they gave it to you for $200. Would you buy it? Even if it wasn't for yourself, what a great investment to give someone one and say, "Holy cow! I'm not going to tell them I got it for $200. They're going to think I paid full price, and I'm going to get a really nice gift in return from them." So everybody probably would buy an iPad for $200. So when the pound was retracing, fundamentally we were strong. They made an announcement in Europe and Sunday night and that kind of stuff. So as the pound got cheaper, I'm saying I want to buy it at discounted prices. So the Fibonacci is just telling me how much cheaper it is than where we just were at the top of this big explosive move. 23% cheaper, 38% cheaper, 50% cheaper, 62% cheaper. So you're starting to try and maybe buy it and accumulate it down here as it bottoms out. So it did bounce off the 50% and went up. So an intraday trader who risked 10 or 15 pips, they buy it at the 50% mark, they put their stop 10 or 15 pips below, and they make 15, 20 pips, 25 pips, whatever they're going. That's a winner off the 50% mark. If they use the 61% mark, they might have had a winner if they were locking in profits. If they were going for something bigger, obviously they had a loser. If you're using the 76, so I'm not telling you that there's a holy grail which Fibonacci to use. You have to combine that with what is driving the markets and your own gut instinct. So remember, if you cover up anything to the right of my mouse, as we started to go down, you could see the equity markets moving down too. So you had to pick a place where you thought the equity markets were going to stop going down and where you also thought that this would stop going down. So what I can't stress enough is we're looking at this in hindsight. As it's happening, you're getting information to update you and tell you, do you want to do it at the 38% mark? Do you want to do it at the 50%? Do you want to do the 61? You're in the intraday, you know, that's what you're deciding as this news is happening, as the equity markets are moving, as you're seeing the pound come down. Maybe you even saw a double top here, and you could measure the double top and say the double top low was here at 55. Let me I have to move this little monitor thing for the presentation. So the double bottom was, let's see, get my crosshair on. So we were around 55.50, and the top of it was around 55.80. So 30 pips below that, I'm looking at 55.20ish or 55.15. So that's maybe why I would set up around. So I'm using another technical indicator in conjunction. I'm using the fundamentals in conjunction. I'm using the stock market in conjunction, my ancillary markets. So there is no holy grail out there. I've got to combine it with other information, okay? Yeah, I do like certain Fibonacci's more than others, but I don't always go into them because I have to time it with other information. And just because I like that Fibonacci doesn't mean I have a winner. I'm going to either have a loser or a winner. I don't have 100% winners out there. There's no way, all right? Nobody does. We're in the business of trading. We've got to be willing to lose money, right? All right, so also there is a relationship between fibs and Elliott waves, absolutely. I like Elliott waves and I kind of pay attention, but trust me, I'm by no means giving a lecture today or a presentation on Elliott waves. I am not an Elliott wave professional. If you guys are interested in that, you know, definitely look into that, read about it. It's a great topic. All right, there's a pennant between, yeah, so you guys are, it's hard for me to read all of these things, so there's pennants and all those kinds of things, sure. Lots and lots of technical patterns. We're staying on Fibonacci for the most part today, and we're actually getting to wrap up. But yeah, all of you guys, it sounds like we have a pretty talented crew out there today that are very, very familiar with a lot of these chart patterns and things like that, and more power to you if they're lining up and if they're successful for you. Perfect. So, you know, don't give away all your secrets to me, that's for sure. I'm not giving you away all of my secrets to you. So let's kind of wrap up here as I delete some of these Fibonacci's. So that's how you kind of use it. You know, everything's right-click in the MetaTrader software, very, very easy to use. And if you have any questions on how to do things within this in the MetaTrader software, that's where you reach out to your broker and Interbank FX, and they're happy to help you with this information. So to wrap up, I don't think I updated the slide as far as when the next event. Oh, I actually did. Wednesday, December 14th. It will be in the evening again, as far as I know right now. That may change, but you guys will get emails about that. It is going to be a year-end review and a look ahead, kind of maybe a macro view, and we'll always, as people ask questions like they did today and bring up topics, we'll always get into fun little sidebars. But again, fundamentals, technicals. This webinar will go through compliance, and then it will go out on the YouTube site, so look for it there in 3 or 4 days, and you can revisit it. Also, you know, like I said, I'm writing similar information on a daily basis at the Daily Forex Trading Edge, also actually on my blog. They're basically the same. Again, this one has to go through the compliance as well. So that's the good thing, is I have my Series 65 as far as being able to manage people's money. So I don't really go into places where I'm giving you guys recommendations. This is all for educational purposes. I don't know any of you guys in your situation, so you have to adapt and filter any information for you here, whether it's from me or whether it's on CNBC, for your account size, for your situation. I call that the system. There is no system out there that works unless you know your system individually, and that's what I do a lot. I give engagement interviews where I learn about the person and I kick back some information so that they have a better, more finite view of what to focus on for their situation. So if you're interested in that, you know how to reach me via email. And then again, this is my tag on Interbank FX. So it's been a pleasure. We had a great turnout, great comments, great questions, and I look forward to having you read my market blog on a daily basis and then seeing you on the 14th just before the holidays for a wrap-up and look ahead to 2012. Take care. Have a great afternoon.